Hello, everyone, and thank you for joining the inaugural podcast of Real Estate Macro. And I am honored to have my friend Bob Flynn joining us today. Bob is a hard money lender and investor, done all kinds of interesting flips and different projects along the way. And we'll get to talk to Bob a little bit about his investing business and go from there. But to give you guys an overview of what I'm trying to accomplish with this podcast is try to add a little bit more of the portfolio type approach into real estate and try to talk a little bit about risk management and try to break down risk management so we maybe hopefully educate the marketplace a little bit. And when I started to decide to think of a podcast and who would be helpful in talking about that, Bob was one of the top names I thought of right off the top of my head. So Bob, welcome to the podcast.
Douglas, thrilled to be here.
Great. And Bob, if you could, I understand just to get us started, you are a Michigan guy, right? Correct?
Yeah, for grad school.
Absolutely. And fantastic. And Bob, can you tell us a little bit about your background and how you got started?
Yeah, sure. So after college, I moved back to my hometown, Boston, and I worked in institutional equity sales, sort of for like smaller middle market type accounts. And I quickly discovered that the hedge funds, the investment managers, the analysts that I was serving were all smarter than me. And the business is very, very competitive. Not that it's impossible to produce alpha, but that it's a hard game. And consequently, I went back to business school in an effort to pivot to real estate. I graduated, got a job in San Diego, which is exactly what I wanted, working for a very interesting, smaller kind of real estate shop. And Lehman Brothers failed a week later.
Oh, wow.
Yeah. So their business had been sort of big picture, predominantly, buying land from like farmers and ranchers, re-entitling it, selling it to builders, doing value add office deals, predominantly where they were taking on lease up risk. And those businesses were dead when Lehman failed. So we ended up investing in some very senior credit instruments, which worked well on a risk-adjusted basis. But ultimately, I was let go like kind of middle of 2010. So at that point, I started making some hard money loans in San Diego because I was a licensed broker. And I kind of watched, by looking at the performance of my clients, I was able to watch the market kind of bottom out, watch the margins, watch how impressive the margins were, frankly, on REOs. And so I ended up, as an investor myself, riding the short sale and the fix and flip kind of REO wave in San Diego. Did a lot of those, did some like larger jobs where we started adding, master suites, eventually built some homes before kind of pivoting into making some multifamily and mobile home park investments in the Southwest.
Outstanding. And Bob, are you still investing in multifamily today as we sit?
No, the last two deals that I closed on, one was a small mobile home park and the other was a small multifamily asset outside Ann Arbor. And that was in January 2020. A few weeks later, saw the images coming out of Wuhan on Twitter, as I'm sure you did, right?
Yes.
And to me, I was like, bing, it's over. I'm making hard money loans again.
Yeah. And you pivoted back to the hard money space?
That's right.
Awesome. And Bob, I'm fascinated. With the hard money space, what attracted you to lending in that arena?
Well, I think one thing is just that if I'm not bullish on an underlying, and in an equity position in an underlying asset class, I might be bullish in other portions of the capital structure, and that was the case here. So I felt comfortable, assuming less risk by being the lender.
Outstanding. And Bob, and I'm thinking mainly the fix and flip space still, or are you handling ground up as well? What would you say is a perfect for your portfolio?
Okay, so the perfect loan for me is someone that owns they own a one-off asset. They're price insensitive. Time is the most important factor, and surety of close is the most important factor. Maybe they own the asset free and clear, and they frankly want to borrow something at a low LTV. Now, that's a harder loan to find, but that's the ideal loan.
Absolutely. And Bob, I'd love to get your input on, in terms of the LTVs declining. Are you seeing like with regard with what we're seeing with economy wise? Are you seeing LTVs starting to drop and big changes in the lending arena generally?
Well, I think more than anything, it's just that I'm quoting loans the same way that I was 12 months ago. It's just less frustrating now. I'm more competitive now, right?
Absolutely.
So as a lender, if you have access to capital as a lender, it's very, very easy to put money on the street, right? So when I look at, like, buy now, pay later product, of course there's a huge TAM, right? I mean, it's like selling hot bread for nothing, or pay me for the hot bread tomorrow, right?
Right.
So as a lender, if you're willing to dramatically raise your LTVs, right, your loan to values, or dramatically lower your interest rates, super easy to put a lot of money on the street. I haven't done that. So I'm just a little bit on the margin. I'm more competitive now that rates have risen.
And for those of you who don't know, Bob has a fantastic blog that really breaks down his philosophy in terms of viewing risk. And Bob, if we could, love to delve a little bit more in how you came across this framework, because I think it's for me, it strikes me as kind of a margin of error type philosophy, that basically you're looking at more the downside risk, not as so much as, well, we think we can get to XYZ return. We're actually looking at the downside risk. And having lived through you've actually gone through a pretty rough down cycle, so you probably have that in your psyche a little bit, where I'm not so sure of most of the latest crop of investors have that in their mindset. So I wanted to introduce that idea possibly of how do you look at downside risk?
Yeah, so with respect to loans, I look at downside risk. Okay, so there's a few different types of risks when you're making a loan, right? So one is bad title. So it's clearly very important that you have clean title, that you have a lender's title policy. The other risk would be that you're lending too much money relative to the asset value. Third large risk would be you're lending to somebody who has a reasonable claim to say that they were a consumer, right? Or that a loan was made for household purposes or personal purposes. So when I think about risk from a quantitative perspective, it's very simple. I'm looking at what I call the Flynn interest rate, right? And it's sort of this, it's just the relationship between the interest rate on the loan divided by the LTV. And what that allows me to do is it allows me to look at loans in kind of an agnostic manner, where a loan that's struck at 9%, but a 25% LTV is just clearly more interesting than a loan that's at 10% and a 60% LTV. So that's how I think about it. Use the Flynn interest rate. I mean, another way to look at this is to think about the incremental cost of debt. And that's really why I'm shying, at least at this portion of the cycle, why I'm shying away from construction heavy and ground up projects. I don't think the incremental cost of debt is sufficient to justify the risks involved.
And that's even in terms of being at the top of the stack, even.
Yeah, even at the top of the stack. Because look, if everything goes sideways, and someone's doing a ground up construction project, if a house is half built and I make enough loans, I'm going to inherit a number of half built houses. Right. And then I've got to deal with GCs and subs. This is on a very small scale. They're not super professional already. They're probably impaired because other people aren't paying them. They've got mechanics liens galore against the property, even though I'm first in line. But somehow I have to turn around as somebody who's taken back an asset and form a working relationship with them. I'm going to end up reaching into my pocket. It's going to happen. And also it's a job, right? Yeah. So I prefer to be paid for providing liquidity. And unfortunately, for several years now, I would say given the Fed actions, it's not an environment where you get paid for providing liquidity, but I feel like the winds are blowing in that direction.
Certainly feels like we crossed over somewhere along the way here recently, we've crossed over a regime. Like there's a regime basically 2010 on where interest rates just keep drifting low, and finally we've and because of COVID, I think, and again, I think this is and I'd love to get your kind of macro view on this as well. We kind of, it's easy to be, you don't like the cure, right? You don't really like the cure of liquidity. They literally had to, well, I feel like they had to shut down, right? To slow the spread, they had to shut down. So the consequences, they had to take a bazooka out and flood the streets. But now we're seeing maybe the second order effects of the cure. And it seems like we've definitely crossed over into a completely set of rules that are different, and would be curious to see if you're reading in that way, and if you see any differences in how I'm seeing that, and how you're looking at it.
Well, I mean, so many implications came out of COVID. But one of the messages that I feel, okay, there's things that I got right, there's things that I got wrong. So what I got right was I became very concerned about my ability as a landlord, and I still own, through partnerships, still own multifamily assets and mobile home parks. I became very concerned about my ability to collect rent. And I was right about that. It's become a major problem. And it's very depending on the part of the country, right? What I got wrong was, at least in the short term, the extent to which we saw asset inflation. That just completely blew my mind. And that was another secondary effect. When markets get detached from my perception of reality, I just don't participate. So I already had exposure to multifamily mobile home parks. I wanted to add exposure to hard money loans because I view it as a yield vehicle where my plan B, and I don't want to execute on plan B, but my plan B is to take back an asset at a very attractive cost basis.
And Bob, moving forward, if there are folks in the audience that are considering buying, let's say, a multifamily asset today, how would you price in the cap rate decompression? Do you have any thoughts on how they should be attacking the cap rate problem in terms of sensitivity analysis?
Well, I mean, I don't have the wherewithal to predict interest rate directions. What I do know is there are different ways to hedge the various risks that are going on right now. So if you can assume a loan, or you can wrap a loan, that might be one means by which you can be positively levered. I firmly believe that if you're using financial leverage, you need to be compensated for the risk. So you need to be positively levered. And if you're not, you have to sit on the sidelines. In terms of the risk of being unable to evict a tenant, I mean, I have a loan that hopefully, God willing, is paying off today that has been non-performing for a couple months. And the root cause of it is that my borrower had a rental, and he's not a large landlord, to the best of my knowledge. So when his tenant stopped paying him, it caused him a tremendous amount of pain. So I'm upstream from that problem, right? And therefore I'm insulated from it. But one way you can bake in the risk of bad tenants is frankly just to buy a property that already has a number of bad tenants and purchase it for enough of a discount. So I think by being positively levered and baking in the sort of tenant related risks on the front end of a deal, you can hedge those two risks in today's environment.
That makes a lot of sense to me. I've really been trying to see how we can attack the problem, because I've always heard this: you can't trade macro. The variables are just too many. It's such a headache. Even, I mean, I'm literally getting out Markov chain Monte Carlo models, and I'm like, this feels like I'm trying pretty hard here. And to be clear, I'm not super strong on mathematics to begin with, and I'm like, is this really the right thing? Should you even undertake this decision under that environment?
So that's above my pay grade. I mean, but if you can identify sellers that have very attractive loans that they took out in the last few years, assume, and the loan's assumable, right? Just assume the loan. I think that's a way to sort of deal with the risk, as long as it's a sufficient term.
Sure makes a lot of sense, doesn't it? If that's even remotely a possibility. And to that end, though, I'd be fascinated what your read is on the. It feels like the predominant business plan in multifamily, for example, has been interest-only bridge debt for the last, I guess, last 5 years, even, it seems. Are you feeling a sense of displacement on the horizon in that arena? Because it sure feels like to me some of those business plans don't feel like that's going to pan out in the long run.
I mean, I don't think at this point, I don't transact enough in multifamily to have a big view of the performance of all the bridge debt that's out there.
Mhm.
But I know this, I know a lot of people who are doing a lot of thin deals for a long time. So anything can happen, right? They can get bailed out by cap rate compression, by interest rates reverting, but absent that, my suspicion is there's some pain ahead for a lot of people.
That's really a strong fascination of mine. I'm like, how are some of these deals? It seemed like they were thin the last couple of years myself, and
Yeah,
in terms of, okay, that doesn't feel like. And I mean, we literally were looking since about 2015, 2016, and really trying to understand, okay, how do you, like, for me, my own journey was, how do you syndicate multifamily? How do you become an entrepreneur in this space? And by the time I'm starting to really actually figure it out, it's like the pricings kept getting crazier and crazier as we went. And the last couple of years, I'm like, oh man, I don't know. Are you winning? And for example, you're bidding against 22 people and you're the winning bid. Are you actually winning?
yeah, of course, right. Yeah, it's very barbarians at the gate-ish, right? The winner lost.
It feels like it to me. And again, I guess I probably is not going to make me very popular at certain multifamily conventions, but I hate to say it, but I feel like there's some pain on the horizon there.
Maybe so.
Yeah. And Bob, in terms of your outlook, in terms of moving forward here, looking forward to mainly sticking with the hard money space and moving forward here.
Yeah, I think so. I mean, one of the lessons that I've learned very slowly is in private markets, in a public market, you can have a thesis and pivot among asset classes to effectuate the thesis pretty quickly, provided you have the knowledge. But in private markets, it's not as easy as just, hitting a bid. You have to create deal flow, and that takes time and persistence. So one of the consequences of me moving from, making hard money loans in San Diego to fixing and flipping houses is there's different cohorts of relationships. And as you move from one portion of the capital stack to another, I found myself having to rebuild new relationships, and other relationships were eroding at the same time. So my intent is to stick with hard money lending. I think it's an all-season business. It's just that the volume that any lender should have should fluctuate over the course of a cycle, right? Ideally, it would be counter-cyclical. So I'll just try to reflect that in my discipline.
And Bob, I guess I never have really asked this question. Are you looking to build out a fund per se and really have a nice platform that way, or are you looking to do more one-off type placements?
Yeah, right now, I mean, I'm just using what's known as a co-invest model, where I'll put up some of my money along with my partner's money, and they'll invest in a one-off basis in deals that they get to choose. So this puts them in a position where their names appear as a beneficiary on an assignment of a deed of trust.
Right.
So they have total control, and I have a little bit fewer reporting requirements. It's more just about 1099 people.
Makes a lot of sense. And again, I guess that's always an interesting, deal flow versus capital access. And it seems like you have really a lot of control over in terms of another party saying, well, I really like Bob, what he's doing. I want to participate. And it seems like having that very discrete, okay, this particular property at this address with this set of variables, it seems like that's a pretty attractive way they can control their sense of, okay, I know exactly within a set of parameters what I'm getting here. And it seems like a really good way to get at it.
It's just how I've always done it. I mean, when I started making hard money loans, it was like weeks after Bernie Madoff was exposed,
Yeah.
right? So
Yeah.
probably the worst time in the last 100 years to raise a fund. So I just started using the co-invest model right away.
Yeah, I still think my favorite T-shirt I've seen is Enron Risk Management or Lehman Brothers Control.
Yeah,
In terms of some of the best T-shirts I've seen, so I completely
yeah,
appreciate that.
sure.
And Bob, is there anything else that I haven't talked about that you'd like to kind of mull over a little bit that's really sitting on your mind and like, gosh, these guys aren't getting this piece of the puzzle?
Hmm. I mean, look, I'm just trying to think about Twitter because we've connected over Twitter,
Right.
right? There's so many interesting, influential people there. I can tell you, one of the things that I've done, one of the ways that Twitter's helped me is, I started following this fellow Maxfield on banks. Do you know what I'm talking about?
I'm not sure I'm following that one.
Okay, so he's
Take a look.
got, he has a list. I think he wrote for American Banker, I want to say, for a long time, for Banker and Tradesman. Sorry, I might be getting it wrong, but so longtime writer. He has a list of like his 100 favorite books on banking ever.
Wow.
And to me, studying the history of banks, particularly bank blow-ups, in a negative art like lending, it's the perfect way to figure out how to think about lending. So shout out to him. He's been a great resource for me.
That's incredible, and it feels like, and again, I feel sense that Bob has done much like I did. I've been heavily influenced by the value investing philosophy and some of the things that Buffett and Munger have done to really, like, these are some disciplines you can take if you want to manage your risk. One of the things I distinctly remember them talking about, the anti model, like look at like what you don't want to be, take a
Yeah,
look at that and use that as a way to, you may not you may not be overly, gosh, what's the right word? You're not overly active, but you're also not trying. You're just basically trying to avoid stupid, more or less, to put it succinctly. Is just let's avoid stupid over here. And
yeah.
I like to complicate things. Bob, look at me. I'm trying to do Markov chain over here, and where they might say, "Oh, what are you doing? Why are you trying so hard? Just don't do something stupid."
I I like the idea of just hedging. So I think of macro, when I think about macro, as interesting as it is, it's a game for people like a 160 IQ kind of game. But if you have a more normal IQ like me, right, you can still think about hedging macro risks. So that's really all that I try to do. And to your point, I would trade 200 basis points of return all day long to hedge risks that could kill me or kill my investment otherwise.
Yeah, and I guess in the professional circles they call that tail risk. And again, how you deal with that the little, it's like, the normal bell curve, and then just on the edge of there's something. It may not look that intimidating on a graph, but some deadly things can happen out there. And so
Totally.
I think you're right. I think and again, it really is an incredibly hard thing to do if you want to play the really intellectual side of, which I'm really magnet. It's really fascinating to me, macro wise. It's very fascinating. I love that macroeconomics, but at the end of the day, it is exceedingly challenging. And again, I'm not super strong with math, so I think your actual pragmatic advice is correct. It's like, just hedge your risk and you can sleep well at night.
Yeah. Yeah. And look, of course, you have to know something about macro to understand what those risks are, right? So
I think that's right. Well, Bob, thank you so much for joining me today. I think we really did a good job of mulling over what your business looks like. And if someone wants to get a hold of you and know more about what your lending opportunities are like and would like to participate with you, what's the best way to get a hold of you, Bob?
yeah, so if you're a borrower, you can find me at flynnlending.com. That's FLYNN lending.com. I have a blog for people that like you that like to hear my occasional thoughts on markets. It's called Inefficient Pursuits. And I spend an unhealthy amount of time on Twitter. My handle is Flynn_Bob.
And by the way, I will say, if you're interested in any shape and form of either a lender or borrower, you'll learn so much about the lending process from Bob that you just have to follow Bob. You just got to do it. So go follow that
Thanks,
Twitter account, folks. Absolutely. Well, Bob, thank you so much for joining us today. Really appreciate the time today.
Douglas, really appreciate it. All the best. Thank you.
Absolutely.